Hey everyone, my name is Corrado Ranjo. I'm a real estate broker here in Toronto, Canada, and today we're joined by Daniel Char from Ultimate Mortgage and Finance Solutions, and we're going to talk about some solutions and options for you to consider because of the COVID-19 pandemic. Some people may be in a position where they can't come up with money for their next mortgage payment, so we're going to talk about the deferral options. Some people maybe just want to refinance their properties and take advantage of these low interest rates. And there's also people that just want to invest and put themselves in a position for some great opportunities. Thank you, Daniel, for taking the time to do this.
Hey Corrado, how's it going? Thank you for having me on your channel. I hope everybody's staying home and staying safe. Let's get right to it.
The Canadian government announced a mortgage deferral program back in March to help those that can't make their mortgage payments. So some of the big banks in Canada like CIBC, National Bank, RBC, TD, Scotiabank, BMO will allow mortgage payments to be deferred up to 6 months. Daniel, can you explain how this works?
Absolutely, Corrado. So in regards to the mortgage deferrals, every lender is different. And when I say that, that means that there are some lenders out there offering only 3 months deferrals and some lenders offering up to 6 months deferrals. So depending on the lender that you're with, you can either have 3 months or 6 months. That being said, you don't automatically get deferrals. You have to apply, that's number one, and then you have to qualify. And the people that would qualify are those that are existing clients, number one, and they're in good standing. So what do I mean by this? If you're a client that signed for a 5-year mortgage and you're in year 3 and you've been missing your mortgage payments for the last 3-4 months, there's a very high chance that the bank would not allow you to defer your mortgage because you've been already missing payments prior to the COVID-19 crisis, right? So you got to be an existing client and your mortgage has to be in good standing. What do I mean by existing client? If you just bought a house yesterday, there's a high possibility or 99.99 chance that the bank will not allow you to defer the next payments because you just made a new purchase. So you're a new client. You're not an existing client. Hope that makes sense.
Are banks in Canada offering a forbearance? And is this a good option for people? Because I know a lot of banks in the US that are offering this.
That is a great question. So I really wanted to find out what my clients would go through or what they would experience if they were to ask for a mortgage deferral. So I called up my own lender for a mortgage deferral and I was offered a 3-month deferral. So I did not have to pay my May 1st and I will not have to pay June 1st and I will not have to pay July 1st payments. Here's the thing though, when I asked the bank rep what would be the case or what would be my maturity balance, they couldn't tell me. They said it would be a couple dollars more per month, but at the end of the day, we will find out at maturity. And I did stress and I did push to get the exact number. What's the real calculation? And my bank was not able to provide me with that number. I had to make a decision. Do I do the deferral or do I not do the deferral? And so just by me going through that experience, I know that there's going to be many Canadians going through the same experience out there right now, having to make a decision without knowing the real outcome. So I guess to answer your question, it really depends on the client's personal scenario. If you really do need that extra time, go for it because it provides you with cash flow today. I'd rather you spend money on your groceries and any other necessities, for example, medical equipment, drugs that you might need for yourself. I'd rather you spend that money than to pay your mortgage if you are given an option for a grace period with no penalties. It's just going to be added up to the balance of your mortgage at the end. Try to stress your bank to give you that number. Unfortunately for me, I did not get that number, and I'm not sure if all Canadians will be given that number. So just wanted to give you full disclosure what I had to go through, even as a mortgage broker.
There's a lot of economic uncertainty in the financial world because of the COVID-19 pandemic, which is translated into a massive drop in mortgage rates. Daniel, do you think now's a good time to refinance your mortgage? See, a lot of people are playing defense, but I think this is somewhere where you should play offense and it could potentially save you a lot of money. What are your thoughts?
Absolutely. I think that is an amazing idea. Mortgage rates right now are above 3%. It makes so much sense to consolidate all that expensive debt by refinancing your home and paying off all that expensive debt. Credit cards are about 20 to 25% depending on which credit card company you're with. So by wrapping all that 20 to 25% credit on a 3% loan makes a lot of sense. You're not only going to save on the interest rate that everybody knows about, you're also going to increase your cash flow. So for instance, if you have 5 or 10 credit cards, a lot of my clients do, they just start racking up credit cards. They forget that every month you got to pay $50 or a certain percentage of the total balance. So every month you're paying your credit cards all the time, and that's only going to the interest. It's not going to principal. When you pay all of that off and you never have to pay another payment again because it's all in the mortgage, your cash flow also increases. So that's another benefit. And there's another benefit that nobody thinks about. I call it stress relief. When you come home at the end of the day and you open your mailbox and you don't see another bill from your credit card company, isn't that a win? So I think there's 3 wins when you're doing a refinance. You're actually paying off expensive credit cards, so you're saving money on interest, you're increasing the cash flow, and you're also reducing your stress in a time like this. Hope that makes sense.
What are the risks to refinance right now, and are the banks going to be tougher?
That is actually a really good question. So the way I see it, I believe that we have 2 options. We got option 1, it's where we take the mortgage payment forgiveness for 3 to 6 months. Here's the thing, if we take the mortgage payment forgiveness for 3 to 6 months, we still have to maintain our credit card payments at 20 to 25%, all right? But we don't have to pay our mortgage for 3 to 6 months. Option 2 is where we refinance our home to pay off all that existing expensive credit card debt. Here's the thing, when we refinance our home, that's a brand new deal now. That's a new deal. So once you do that, you don't have any more expensive credit card debt, but you got a new mortgage that you're responsible for. If anything happens to your job, you're still responsible for that mortgage every month. And if you call the bank for a mortgage deferral, they're most likely not going to allow it because that's a brand new deal.
There could be a lot of fees and upfront costs and cancellation fees to get out of a mortgage to refinance. What's your advice for people that are considering to refinance?
That's an excellent point, Corrado. So every mortgage has a penalty schedule. So whether it's a 3 months interest penalty or something called interest rate differential, which is very complicated for whatever discount we gave you when you signed the contract. If you break the terms, we want all our discount back. That's basically what it means. So essentially there's 2 types of mortgages. We got a variable mortgage and we got a fixed mortgage. The variable mortgage, mostly you're just gonna pay 3 months interest. So if your mortgage payment is $1,000 a month and it's $500 for principal and $500 for interest, all you gotta calculate is 3 months of that interest. So 500 times 3 is $1,500. So that's what you're gonna pay to refinance. If you're in a fixed contract, it really depends on how much money you owe right now and how much term you have left. So if you signed a 5-year deal and you're only 1 year in, believe it or not, your fee is gonna be very expensive to break. If you signed a 5-year term and you got only 11 months left into the deal, they're going to be a lot more forgiving on the penalty costs. So it really depends on how much money you still have outstanding on the balance and how much time you have outstanding. And just to answer your question before about the new criteria for banks, yes, they are getting more strict on how to qualify for mortgages right now. So before it was very straightforward. We just need a job letter, a pay stub, everything has to make sense and we're good to go. We can get you the money. Nowadays, because the banks know that most clients may have lost their jobs or or are at risk of losing their jobs, they just want to have more reassurances. So they put more stricter guidelines in place. For example, a telephone verification, instead of having a job letter that could be 60 days old, they want something that's within 30 days. And they might have some more parameters involved in that too. So before you refinance, I would contact your bank, find out exactly what your penalty structure is before you commit to doing a refinance.
What's your advice for the investor? Maybe somebody that's saved up a lot of money for many years, or somebody that's in a position where their job is not really being affected by COVID-19. Should they go out and get a pre-approval so they can put themselves in a position to invest?
All right, so for the investors, I think this is a little bit tricky, especially because of this COVID-19 pandemic. This is an area we've never experienced before. So we're seeing mass amounts of job losses. So if you buy investment property and you got no tenant to pay you, how does that affect you, right? So that's one component we got to look at. Another thing is we don't know when the bottom is, where the bottom is, and when it's going to hit. So about 5 weeks ago, when we started sensing this pandemic coming to fruition, I've been seeing a lot of Facebook posts from real estate agents, real estate investors shouting out that this is a great time to buy because it's a bad time. So when times are bad, things get cheaper, and this is a great opportunity for us to get into the market. I was advising against that because here's the thing. We don't know if it's going to go lower. If you find $1 million property and you see that it went to $800,000, yes, you saved $200,000. It looks like a great deal. But here's the thing. We don't know if it's going to go to 600. We don't know if it's going to go to 400. Most likely in Toronto, it's not going to get to that level. But I want to remind you guys about Detroit. Detroit was a bustling city back in the day, 50 years ago. Prices were high. And guess what happened? Prices in Detroit started dropping all the way to, I think right now you can buy a piece of property for about $20,000 to $30,000 in Detroit. So I would say you got to find where the bottom is before you get back in. And what I mean by bottom is we got to see a vote of confidence, because you can buy something at a discount and just get murdered again in the decrease of value. So if everybody's selling, the price is just going to keep dropping, right? And if everybody keeps buying, the prices are going to keep going up. So you got to find that equilibrium of when the best time is. And I'm not trying to say time the market. I'm just trying to say you got to see a vote of confidence. And right now, I don't see any confidence in the market right now. Interest rates are rock bottom levels. Bank of Canada overnight lending rate is at 0.25. We got one more bullet left to go to 0%. And we're hearing talks of negative interest rates. So we don't even know what that's going to do to the real estate market. So if you got cash right now, my advice is let the dust settle for now before you start buying into an investment property, because everything's about cash flow unless you're speculating. If you're going to buy an investment property, you're writing down what the market rents are. And if we don't know what the market rents are, or we don't know if people can even pay the market rents, that's not a very good starting point to get into an investment, right? Now, if you're trying to buy a house for yourself to live in because you need a place to live in, you're currently renting and you want to buy a house to live in, that's a different story. I'm talking about the people who have a house to live in. They got another rental property. They're probably looking for number 3. I would say just hold off right now. Unless you're buying pre-construction, that's so far out in the future, but everything's future price right now. That's just my take on it. Hope that makes sense.
What's your advice on the people that bought, let's say a few months ago or a couple years ago when the mortgage rules were different? Let's say they got to close on a property in the next couple months and they don't get approved by an A lender because some of the rules have changed and they got to go with a B lender. What's your advice on that? And also, is it harder for somebody to get a mortgage now if they're an investor or an end user, or is it the same?
So if you bought a property and it's coming to closing very, very soon, I would say you got to talk to your bank, your mortgage broker, whoever you're working with, to confirm that you got a solid deal. You got a firm approval. And I don't mean a pre-approval. There's a difference between a pre-approval and a real approval. Pre-approvals don't mean anything. Okay, so talk to your bank, talk to your mortgage provider, and confirm is this a solid, real approval, and will I close? Make sure you talk to them and confirm that they got everything lined up, because at any time the bank can still come back to you and ask for new documents just to confirm that you still have your employment. You're not going to be losing your employment. They can do a final verification check with your employer. So you want to have all that checked out before the closing date. And in regards to, is financing a little bit harder today than it was before the pandemic? Absolutely. Banks do know that people are losing their jobs or have lost their jobs. So they want to make sure that when they send out money for a mortgage, when they close on a property, the client, the borrower, actually has the capacity to pay back this loan. Keep in mind that banks, they're a business and they are responsible to their shareholders. So they cannot afford to give out loans to people who cannot repay these loans. All right. So if somebody does not qualify for a traditional bank mortgage, they would have to go to a mortgage broker that can provide them with something called a B lender mortgage, alternative financing, or a private mortgage. And what these are lenders that are more lenient when it comes to income and credit. They could take more debt to income ratios. So for example, if you're not making enough money, at least with alternative lenders, they can stretch the criteria out. Whereas with an A lender, their box is very narrow and rigid, because AAA banks like your Scotiabanks, your TD banks, the banks that you do your daily banking with, where your payroll goes into, they want the cream of the crop. They want very high income, very stable income, excellent credit, and good down payment. As soon as you start falling off these three criteria, you would have to qualify at alternative lenders that can take a little bit bruised credit and will forgive some of the income shortages that you may have. And if you did lose your job fully, you have no more income, there's another solution. This is called private lending. And private lenders, they don't really care about your income. They can forgive bad credit. What they're looking for is equity. As long as you have enough equity or down payment to cover the closing costs, they will close the deal for you. Mind you, because you're not using income to qualify for this deal, the interest rates will be significantly higher than you're used to, and there will be fees. So that's one thing I do want to mention. There are alternatives out there if you have lost your job or your credit has been impacted with this virus. Now, in terms of, is it more difficult to get financing for an investment property versus a principal residence? Yes. When it comes to investment properties, it is more expensive on the mortgage rate, and also it is more tougher on the qualifications due to the fact that you're not living there. So you're relying on a third party, your tenant, to provide you with the income to support that deal. So it is going to be a little stricter in terms of the guidelines. Before, all we needed was a lease agreement to confirm the income. Now we do need a market rent appraisal, something called Schedule A when it comes to appraisals. And also the banks may require seeing the deposit going into your bank account to prove that tenants are paying their mortgage, their rents. Hope that helps.
Daniel, thank you for taking the time to do this. If you guys have any questions about mortgages, leave them in the comment section below. If you're looking to get a mortgage, I'm going to leave Daniel's info in the description of this video. And again, please like and subscribe to my YouTube channel. The more you like my videos, the more YouTube is going to share it, because that's how the algorithm works. Thank you guys for watching. Adios. Hey guys, it's Corrado. If you want to watch more videos, just click over here. If you want to subscribe, which that would make me really happy, just click over here. you subscribed yet?